Let's take a look now at bearish strategies. The Wealth Creation Alliance bearish strategies utilize the three trend following systems to identify buy and sell signals. When the MACD, major trend, or intermediate term trend system indicates a price downtrend, traders can initiate two types of limited risk bearish trades: purchasing put options and bearish option spreads. Now, I generally do not recommend shorting stocks, as this incurs too much risk and you can lose more money than your initial investment. For put option purchases, I use the major trend system for long-term purchases, the intermediate term trend system for medium-term purchases, and the MACD for short-term purchases. As a general guideline, I will use the major trend system for a trade of 6 months to 12 months or longer, the intermediate term trend system for a trade of 3 to 6 months, and the MACD for a 1 to 3 month trade. Many times I will purchase a put option after a sell signal occurs, which is the crossover of the moving averages, and then use the money management guidelines presented in Chapter 1 of the Wealth Creation Alliance Members Only Manual for exiting a profitable trade or exiting a losing trade. Let's look at an actual put option trade I made recently. My brokerage confirmation shows that I purchased 5 of the Korea ETF January 60 strike puts, symbol EWYMH, at 1570. I used the major trend system and intermediate term trend system, which were on a sell signal, to select this trade. The Korea ETF was also trading at a series of new 52-week lows, which confirmed the price downtrend. Now let's use the put option purchase calculator to analyze this put option trade. Instructions on using the put option calculator are included in the Wealth Creation Toolbox Manual. The put option purchase calculator is helpful in analyzing the profit or loss potential for a put option purchase. This analysis can be done prior to purchasing a put option. There are 4 inputs that need to be typed in for the put option purchase calculator to generate a return analysis. In this example, type in EWY for the stock symbol. The stock price is 44.40. The option strike is 60, and the option premium is 1570. Then in the percent change row, which is the first row of the calculator, type in your desired price percent change for EWY stock at option expiration. This is a user input and can be changed to any desired percent change. In this example, I chose a range of percentages from a 15% price decrease to a 10% price increase. Then click Calculate, and the calculator will calculate the profit-loss potential for this option. The calculator will also calculate the time value and intrinsic value for the option. In this example, the time value for the EWY 60 strike put is 0.10 points, and the intrinsic value is 1560. The put option purchase analysis displays the profit potential for this put option purchase, assuming various price changes for EWY stock at option expiration. The second row is labeled stock price and is the EWY stock price that corresponds to the percentage change listed on the row above. The option value row lists the value of the put option, which corresponds to the price of EWY stock. The rows labeled profit loss and percent profit loss list the point profit or loss and the percent profit or loss for the option. The maximum risk on this trade is $1,570, which is the cost of the option. There is no limit on the profit potential of a put option purchase. The put option purchase analysis reveals that if EWY stock decreases 15% to 37.74 at option expiration, a 41% option profit would be realized. And if EWY stock price remains flat at 44.40, a 0.6% loss would be realized. And a 10% increase in EWY to 48.84 results in a 28% option loss. Now this would be an example of an in-the-money put option purchase with high intrinsic value and very little time value. EWY stock would only have to decrease 1% for this option to profit. This put option purchase analysis reveals that in-the-money put option purchases are moderately leveraged. A small decrease in stock price can result in a moderate option profit. A small increase in stock price can result in a moderate option loss. Risk is limited to the cost of the option. The profit potential is not limited unless, of course, the price of the underlying stock drops to zero, and the underlying stock must decrease in price in order for the option to profit. This brokerage account portfolio statement contains examples of put options and bearish ETF funds I purchased using the MACD major trend or intermediate term trend system combined with the 52-week low trend confirmation indicator. On September 15th, this portfolio had a one-day return of 14%, while the Dow Jones Industrial Average lost 504 points, demonstrating the advantage of being able to trade from the short side. Now the last strategy we will look at is the bearish put option spread. The put option spread strategy utilizes the three trend following systems to enter bearish put option spreads. When the MACD major trend or intermediate term trend system indicates a price downtrend, traders can enter bearish put option spreads. Bearish put option spreads can be initiated by purchasing a put option and selling a put option with a lower strike price. The put option purchase and sale can be done simultaneously, or you can leg into the spread by purchasing a put option and selling a put option to create a spread at a later date. Let's take a look at a put option spread I initiated recently. My brokerage confirmation shows that on August 26th, I purchased 5 of the Russia ETF November 50 strike put options, symbol RSXWX, at 13 points, and on September 8th, I purchased an additional 5 contracts at 16. Then on September 9th, I sold 10 of the Russia ETF November 45 strike puts, symbol RSXWS, at 1360. This created a bearish put option spread. Now I used the MACD and intermediate term trend system, which were on a sell signal, to select this option. The Russia ETF has not been trading long enough to generate a major trend system buy or sell signal. Now let's use the put option spread calculator to analyze the profit loss potential for this put option spread. The 2 purchases of the RSX 50 strike puts were made on August 26th and September 8th, and the sale of the 45 strike put to create the spread was not simultaneous and was legged into at a later date on September 9th. Legging into a spread can result in a higher return than a simultaneous entry if the existing option purchase has an open trade profit when the short option is entered. In this example, the purchase of the 50 strike put did have an open trade profit when the 45 strike put was sold to create the spread. There are 6 inputs that need to be typed in for the put option spread calculator to generate a return analysis. In this example, I would type in the stock symbol RSX, the stock price of 34.20, the buy strike of 50, the buy price of 14.50, the sell strike of 45, and the sell price of 13.60. The put option spread analysis displays the profit potential for this put option spread, assuming various price changes for the Russia ETF stock at option expiration. The first row of the analysis is labeled percent change and assumes various percent changes in the RSX stock at option expiration from a 30% decrease to a 30% increase in price. The spread analysis reveals that if the RSX stock decreases 30% to 23.94 at option expiration, a 455% profit would be realized. If RSX stock remains flat at 34.20, a 455% profit would be realized. And a 30% increase in RSX to 44.46 would also result in a 455% spread profit. The maximum profit potential for a put option spread is realized if the underlying stock closes at or below the strike price of the short put option. In this example, the maximum profit potential is 455% and is realized if RSX stock closes at or below 45 at option expiration. This put option spread analysis reveals that legging into a spread can result in a higher return than a simultaneous entry if the existing option purchase has an open trade profit when the short option is entered. The put option purchased profits if the price of the underlying stock decreases in price. The put option sold profits if the price of the underlying stock increases in price and from the time decay of the short option. Bearish option spreads can normally profit if the price of the underlying stock increases slightly, remains flat, or declines. A small increase or decrease in stock price can result in a large option spread profit. A flat stock price can result in a large option spread profit. Risk is limited to the cost of the spread, the profit potential is limited, and the cost of option spreads is normally low, enabling you to trade a diversified portfolio of spreads in a smaller trading account. This concludes our overview of the wealth creation trading strategies. I hope you were able to gather some wealth building concepts that will start you on the road to success with the Wealth Creation Alliance. The Wealth Creation Manual and DVD have been an inspiring trip down memory lane for me. It was great looking back at the early strategies that helped pave my way to success and fortune. Sometimes I can't believe this all started with just a simple trend following system in the 1980s. That system helped pave my road to financial freedom. And now you too can start down that same road. I hope that one day you can say it all started for you with the Wealth Creation Alliance. This marks the end of the DVD portion of my presentation, but not the end of your Alliance participation, and certainly not the end of our relationship. This is only the first step in our 6-step learning process designed for you, the Wealth Creation Alliance member. I always consider my member's success my success. I encourage you to listen to the DVD and use it and the members only guide as needed. I look forward to talking with you and our fellow members in our forums and live seminars. I'm excited about the challenges and successes ahead of us. Together we can do it. Together with the Wealth Creation Alliance, we hold the key.